Would 3 or even 4 digits in the silver nominal price, the price that we see, would that be outrageous? No, it's worth at a minimum $1,300 an ounce, and that's just based on the 20th to 1.
Gold just blasted past $3,500 an ounce, hitting record levels and shaking global markets. Silver is charging higher too, climbing to prices we haven't seen in over a decade. Central banks are buying, investors are fleeing the dollar, and confidence in fiat money is starting to crack. But here's the real story. Financial analyst Lynette Zang argues this is only the beginning. She believes gold's true value isn't in the thousands, it's in the tens of thousands per ounce. And when that happens, silver won't just rise, it will absolutely explode, shooting into the hundreds or even thousands of dollars. So the question is, are today's headlines just another market rally or the start of a historic revaluation of money itself?
You know, as long as derivatives exist, right? So silver futures where they can create as much silver as possible. But then again, remember, we're coming to conclusion, and I do consider what happened in 1980 at that $50 mark. I consider this a massive double cup because it did come up to breach that level. And so when it goes above that 50, you know, would 3 or even 4 digits in the silver nominal price, the price that we see, would that be outrageous? No, it's worth at a minimum $1,300 an ounce, and that's just based on the 20th to 1 that historically we were. These were both, well, it's peace dollar, okay? These are both a dollar, little $1 gold coin and a silver dollar. So that's a 20 to 1 ratio right there. So according to my calculations, you're looking at the true fundamental value of an ounce of gold at somewhere between $33,000 and $40,000 an ounce. So at $3,400, spot gold is a ridiculous bargain. But that also then means that silver's fundamental value at this moment is somewhere between $1,300 and $2,000. And remember, the more of this that they do, the higher those numbers go, because this is fiat money, government debt-based money. But gold and silver are sound money. Sound money is money that governments and central banks cannot inflate away. They can manipulate what you see through the use of garbage, derivatives, but they cannot inflate it away. The point is they are both money. They're just the opposite sides of that money coin. And as this loses more and more and more of its purchasing power value, these go up in nominal terms. But what they really do is they create a bridge, because when one currency goes away, another one comes in. It's just that you need something and I need something. We need something that will hold its purchasing power intact to get us from one system into the next system. And dare I say it, even have the ability to take advantage of the opportunities that will present as these extremely severely overvalued fiat money assets. And real estate is actually not pure fiat money, because it is a tangible as well, but it's severely overvalued. That's going to flip-flop. So if you can hold your purchasing power intact, you're going to be able to have that wealth transfer your way. Well, I personally do not see it. I see it as inevitable, because what gold really does is it regains confidence. I mean, they want us to think that gold is an old relic, except wedding rings are generally in gold. You know, good as gold. It's in our vernacular. It's in our DNA. And it's used to regain public confidence after that massive failure, which I believe we are like this close to experiencing, and the hyperinflation. But make no mistake, every single country has a gold revaluation account. They're not going to do it at these levels because it does not reflect all the paper money that's been issued. So what I think we will see, and it's just a repetition of history, because this has happened over 4,800 times. I don't think this time is any different, and that's really what the point is. But they have to, you have to kind of back up to move forward. If they did it now at the artificial level that the spot markets are, then it wouldn't have as great an impact if they wait until they finish blowing up the currency in a bout of massive hyperinflation. And what they do then is, of course, they lop off zeros so people think, well, they've got this under control. So you've got a loaf of bread. And I know this sounds outrageous, but it's not outrageous. It is just a repetition of history, where a loaf of bread might go for, as it enters hyperinflation, a loaf of bread might go for $80,000 a loaf, right? But then what happens? They lop off 3 zeros or 4 zeros as they do that overnight revaluation. And so it goes from $80,000 a loaf to $8 a loaf. But so do your savings, and so to anything that you've accumulated in fiat. And frankly, so will the nominal price of gold. First, it'll go up massively, right, in the hyperinflation. But the difference between, say, your stocks and everything else, that drops dramatically immediately upon the revaluation. Whereas gold, it's on average, so I can't guarantee this, but on average will stay up at that level for about 9 months before it too gets revalued, but then it instantly begins to climb again in terms of that new currency. So that is what I anticipate seeing. I don't anticipate seeing it before we do hyperinflation, because there is not yet the need to regain that public confidence. But I watch that like a hawk, because that, my friend, is the only thing that's keeping all of this stuff together. Well, the Genius Act is the first legal foundation for cryptocurrencies and stable coins in particular. I personally believe, there are many reasons why this administration made the choice to legalize that. There's definitely stakes in the game. But it had to happen anyway, because we're moving into a new digital system. And what nobody really realizes yet, and I'm so glad I'm old because I've lived through this and I know how to recognize it, and I've studied it since 1987. When President Trump signed the Genius Act, he changed the global monetary system. And I believe that, I'll put my technical neck on the line with this. I'm not even giving myself any wiggle room in here. Although, of course, I will say I could be wrong, but from the tip of my head to the bottom of my feet and every single area in between, I believe that this will now usher in the hyperinflation to burn off the debt that's being created. But make no mistake at all, when he signed that, the monetary system changed, period. Now, the fact that most people don't know about it yet is not relevant, but I was there in 1965. I was about 11 years old at that point, so I didn't really understand what happened, but I remember that period of time. And I was there in 1971 when we went off the gold standard. And I remember I was about 17 years old. So I definitely remembered all of the chaos and everything around that currency regime shift. And there is not one doubt in my mind that we just experienced that a couple of weeks ago, or 3 weeks ago, whenever he did that, the beginning of this month.
Right now, gold is trading around $3,552 an ounce, just below its all-time high of $3,578. Analysts point to expectations of U.S. rate cuts, a weaker dollar, and massive central bank demand. In fact, central banks added nearly 300 to 400 tons of gold in just the first half of this year. That kind of demand isn't about speculation. It's about survival in a shifting monetary order. Analysts are forecasting gold to reach $3,675 to $4,000 by mid-2026, with some even calling for $5,000 gold if global trust in U.S. debt keeps eroding. Silver is also making moves. It's hovering near $40 an ounce, the highest in 14 years. Unlike gold, silver isn't only a monetary metal. It's also essential for solar energy, electric vehicles, electronics, and even AI technology. With supply tight and industrial demand climbing, silver has multiple engines driving it higher. HSBC recently raised its 2025 forecast to $35 an ounce, and chart analysts say the breakout could push silver past $41. Now, here's where Lynette Zang's warning comes in. Historically, gold and silver traded at a 20-to-1 ratio. If gold's real value is between $33,000 and $40,000 per ounce, then silver should be between $300 and $2,000 per ounce. That makes today's $40 silver look not just cheap, but dangerously undervalued. She also highlights what happens in hyperinflation. Prices of everyday goods spiral out of control. A loaf of bread can cost tens of thousands. Then governments lop off zeros to reset the currency, but savings vanish overnight. Gold and silver, on the other hand, surge during the crisis, hold their value, and then reset higher under the new system. This cycle has repeated over 4,800 times in history. Combine that with the rise of stablecoins and digital assets, and you can see the pattern forming. Confidence in fiat money is the only thing holding today's system together. Once that confidence breaks, gold and silver will do exactly what they've done for thousands of years: reprice overnight and preserve wealth when paper money fails.
And that was about, look, this is the way I view President Trump. He is a change agent. This change had to happen because we have used up all the purchasing power value in this stuff. And once you do that, there is no place to inflate away. You must attack principle. But since at the same time, what's been happening is a shift in the allegiances on a global basis. So the rest of the world has, as we know, they've been turning away from the U.S. Treasury market, which is the foundation of the global financial system. Well, when one market goes away, they got to find a new one. And so by legalizing the Genius Act and requiring all of the stable coins, at least that are issued by this country, to be dollar-backed one-to-one, what he's done is created a new artificial market, just like Kissinger did back in the 80s, 70s and 80s with the petrodollar. So that's what he's attempting to do. And right now, according to a recent article, think about this because it's crazy, right? But in a recent article by the St. Louis Federal Reserve, they talked about the impact of the stablecoins. And right now, there's about 125 billion stablecoins in this market. And most of them, it could be, I don't have this number in front of me, but somewhere between, I think it's even 99% of currently all stable coins that are issued are dollar-based. And they've been adopted majorly in third world countries, particularly in Africa, where their currencies are experiencing very, very high inflation. So what he's done is he's made sure that every new stablecoin that's going to be issued by any corporations in the U.S., because that's who issues them. We don't want CBDCs here. Okay, well, I'm pretty sure we don't want stable coins either. But the CBDCs have a central location, and there would just be one per country. The stable coins are issued by any corporation. So we'll have Amazon stable coins and Walmart stable coins and Kmart stable coins and, J.C. Penney, as well as J.P. Morgan, as well as Hong Kong stable coins, the yuan stable coins. So it is an extraordinarily fragmented market, but they are thinking that within the next 2.5 years, by 2028, they will go from about 125 billion stable coins to $2 trillion in stable coins. And they are busy creating the legal framework of safe harbors and exemptions and all of these things. So if I take you back to 2008 and the great financial crisis, where what these bankers did was disgusting and vile and cruel and destroyed so many people's lives, nobody went to jail. And they didn't go to jail because legally they didn't do anything wrong. Ethically, it was horrible, but legally it wasn't. And they're setting that same kind of system up now and encouraging all of this experimentation. And guess who's the guinea pigs? And guess who's just about the right size to fail? But that's also why I say that this is what's ushering in the hyperinflation. Because the easier and cheaper it is to create new money and spend new money, the more will be created, the more will be spent. And really, how do you even value any of these cryptocurrencies? I mean, if they do a physical representation, because that's all this is, these aren't Bitcoin or Ethereum or XRP, they are the physical representation. And I find it so interesting that they make them look like 1 ounce gold coins, 100%. So, but now think about these numbers, right? If you've got 2 trillion coming in through stablecoin issuance and the Fed doing an about face onto their balance sheet of 2 trillion, that pretty much covers all that new debt that comes out in that big, beautiful bill, isn't it? Doesn't it? You know, I mean, it's just to keep the game going, and they can, as long as the public maintains confidence in the system. Because bank-to-bank confidence, that ended in 2008. Central bank to central bank confidence, and if you want me to go into any of these in more detail, but that ended in 2015. Market to central bank, remember that they would tell the banks what they're going to do. Forward guidance. We're going to tell you what we're going to do so you can get into position. But that ended in 22. So there's only one layer of confidence that's left in this system, and that's the public still hoping beyond hope that this can regain some of its value. That's hopium. That is not a good plan. And it doesn't really work either, because the cards are stacked against you.
So, are we already entering that moment of revaluation? With gold smashing records and silver testing new highs, are we seeing the start of the monetary reset Lynette Zang has been warning about? I want to hear your take. Do you think silver can really hit $100, $500, or even 4 digits? Will hyperinflation force governments to revalue gold much higher? Or will digital currencies and stablecoins delay the inevitable collapse? Drop your thoughts in the comments below, and let's see what the community thinks. If you found this video helpful, don't forget to like, subscribe, and turn on notifications so you don't miss the latest updates. Because in a world where fiat money is weakening, those who prepare with real assets like gold and silver won't just survive, they'll be the ones shaping the future of money.